So we're about 2 months from the end of the year, and now is the time where you can save big money in taxes if you're smart. Today, I'm going to cover 6 strategies that you can use between now and the end of the year to greatly increase your tax savings. These are things we do for our clients regularly, and I know that they can be helpful for you too. If you've not met us yet, I'm Thiago, and I run a financial planning firm right outside of Washington, D.C., and we specialize in working with successful federal employees. And my team and I do this by focusing on 3 major retirement components: helping you maintain your lifestyle in retirement, reducing your taxes, which is what today's video is on, and making sure that your assets are doing what they need to be so that you have a sustainable retirement. So good, solid tax planning is actually a year-round event. But even if you've waited until now, you still have time to utilize these. So we're gonna jump right in, and we're gonna move pretty fast, and don't worry about taking notes. We've got you with the blog. Below the video, there's a description box. Inside the description box, we're gonna put a link to the article that has all of the notes. So the first tax smart move we'll discuss is something called bunching. Bunching might allow you to increase your deductions to levels that reduce your overall tax bracket. Doing so could mean that you could save thousands, if not tens of thousands of dollars in taxes. Now, in order to do this, you need to itemize. Most people don't itemize because currently the standard deduction is pretty significantly high, and a lot of people don't have enough deductions to break that threshold. So that's when bunching comes in. You can group certain deductions together in the same tax year so that it pushes you through the threshold and reduces your taxes. Let's look at how this works. So here's a list of some of the things that you can bunch. So let's say that you have $15,000 in mortgage interest and about $5,000 in real estate taxes. So you're already at $20,000. Now the standard deduction for a joint family is $25.9 thousand. Now let's say you donate regularly about $2,000 a year, and you've had maybe $3,000 a year in medical expenses lately. That's $25,000, and you're just shy of that threshold. Well, if you can bunch your medical expenses together, say 3 years worth where you have $9,000 and maybe 5 years worth of your deductions, you now have an additional $19,000 in deductions available for you to use. And this now puts you over the threshold for the standard deduction. Now here's where I tell you to speak with your accountant before doing this. This is a more advanced tax planning technique, and you want to make sure you do it correctly. The bottom line is you want to be looking through your tax projections to make sure that this makes sense to do so. All right, we're moving on. Tax loss harvesting. If you're watching this as one of our clients, then you already know we're doing this year-round for you. This strategy is extremely underutilized. Here's how it works. Let's say that you bought an investment for $100 and it went down to $80. Sounds like this year, am I right? If you sell this investment and realize what's called a capital loss, you get to maintain this $20 loss on your record. Then you can purchase another similar investment that will perform in a very similar way and wait for that to recover in value again when the markets go back up. So let's say this new investment of yours is for $120. And then it went up to $140. Well, if you sell this new investment, you've made a capital gain of $20, and now you're gonna owe taxes. But remember, we harvested this tax savings before, so you can offset this $20 gain with the tax savings from before and potentially completely wipe out the taxes that you would have ordinarily owed. So not only did you not lose money because you recovered with good portfolio management, but you also made money and you didn't pay taxes. Now imagine doing this with your overall taxable portfolio and think about the difference it can make. For some of our clients, we've been able to add alpha or increased value in as much as 5% of their overall portfolio. That's a lot of tax savings for 1 year. And that was because this year was very volatile, which gives a lot of room for this strategy to work. In the end, it's kind of nice to be able to make some money while the markets are not performing so well. This is one of the ways that the richest families in America pay very little in taxes. Now, very important, please make sure you understand the wash sale rule. The IRS is very serious about making sure you're not just washing your gains and your taxes away. So you cannot repurchase the same investment you used for tax savings within 30 days. Again, I suggest that you work with advisors on this because it's a rather advanced technique. But in the meantime, we have a cheat sheet for tax loss harvesting that we're happy to send to you as long as you send an email to info@rmgadvisors.com And in the subject line, just put tax loss. All right, next one, strategic use of donor advised funds. If you're philanthropic in nature or you donate a lot, this could be for you. Rather than simply writing a check to a charity, the use of a donor advised fund can really be beneficial, and we'll show you how. A DAF is a vessel by which you can make distributions to charities and count those as deductions towards your taxes. All right, so let's say this box is your portfolio. Rather than taking money from it to send a check to charity, and then having to pay taxes on it, you can send money directly from your portfolio straight to the donor advised fund. This money or asset, if you sent a stock, now gets to grow tax-free, and then you, as the manager of the donor advised fund, can now tell it to send donations to the charities that you care about. But here's the big tax savings. Not only does it come from not having to pay the taxes here, but you also get the full amount deducted as a charitable deduction on your taxes. This is really a great one, especially if you have a good bit of assets to your name. The next one to consider utilizing are qualified charitable distributions, or QCDs. This is similar to the DAF, where instead of taking money out of your retirement and losing a third of it to federal and state income tax, and then writing a check to your charity, you might be able to move it directly from your retirement account straight to a qualified charity and not have to pay taxes at all on that money. If you're 72 years old, you know that you have required minimum distributions, or RMDs. These RMDs often force people into higher tax brackets, and that higher tax bracket could mean that you're actually paying more in taxes than you are donating. And then not only do you get the write-off, but that also counts towards your RMD. Just make sure you do it correctly so you don't blow up the tax savings. All right, this next one might be obvious, but it's maximize your retirement plan savings. If you're not already maxing out the TSP, the limits change every year, or for most years anyway. Make sure you're doing the max that you can. Anything that's traditional is going to deduct from your taxes at this year. And really, you should be projecting your income going forward to determine, does it make sense to do traditional right now, or does it make sense to do Roth right now? Again, work with an advisor to determine your income projections. Now, in addition to the TSP or 401k or whatever retirement account you might have, you also have the ability to contribute to an IRA. Just make sure that your IRA contribution can in fact be deductible in this year. You can phase out of that, understand the rules if you make too much money and you have a retirement account. Okay, now this next one is probably the most important one of all. This is one that we've used with our clients that has helped some of them save as much as hundreds of thousands of dollars in taxes over the course of their retirement. Now, you might have already guessed, this is through Roth conversions. And in this video right here, we talk through exactly how to maximize this strategy so that you're doing the best you can to keep those taxes off the table. I hope we'll see you there. And until then, stay wise and stay wealthy.